Now, my pleasure to welcome everyone to today's conversation. My name is Kaitlin Horsch. I'm a financial advisor with Ellevest, and I am joined by Ankur Patel, our Vice President of Investments. Hi, Ankur.
Hi, Caitlin. How's it going?
It's going all right. It is tax week, so it's
Yeah,
been busy.
it's busy, but it's finally warming up outside and markets are up, so not a lot to complain
Yes.
about.
Lots of silver linings, that's for
Yeah.
sure. Awesome. Well, let's dive right into things. So I think just to start, Ankur, I know there's been a lot of ups and downs already this year, specifically with some of the geopolitical issues going on. Can you give us maybe an overview of just where we stand as of yesterday? I know things are changing even today, but just where we stand overall in the markets.
Yeah, absolutely. I think it's always helpful to take stock of, what markets have done over the course of the year. And right now, as it stands as of yesterday, we're looking at a landscape where stock markets are up actually, which is surprising considering all the news about the war and conflict in the Middle East, the rise in oil prices, which here you can see is driving these commodity returns this year. But you'll see on balance, the S&P is up 1%. With today's action, I think you're looking at closer to 2% if things stay as is. International markets here are higher than the US. We've seen the dollar sort of come back down a bit as there's been positive news on the war.
Mhm.
And cyclical sectors like small caps continue to do well. And I think what we've seen is the rebound of hope and expectation that this war will be short-lived. We're still in a phase of blockade with the US sort of controlling the gateway of the Strait of Hormuz, which controls about 20% of oil and natural gas globally. And so I think, it remains to be seen how this ends up playing out. There's just a lot of hope and optimism that, there is a deal to be made sooner rather than later, and oil prices do come back down to earth. That seems to be where we're at today. I think if you look at things like earnings, like the fundamentals of what's driving the market and the hope that exists in stock markets today, you'll see earnings are at about 15% year-over-year growth rate, which is really strong. I think if you look at expectations of forward-looking earnings are also really strong. They're expected to end up 17% by the end of the year over year. So that's a really strong backdrop for stocks. I think one of the risks of, you know, I think one of the other benefits right now that the market's absorbing is also with stock prices coming back down due to the conflict and earnings expectations and earnings growth rising, you're seeing valuations come back down to earth. And
Mhm.
so it has been a more attractive time to invest for stock investors. That's been welcome. And I think when you look at other things related to the war, we can get into, but things like gas prices are obviously higher. And so there are some risks still out there in terms of what's to come. Oil prices are still close to $100 a barrel. And, even when we sort of got into this conflict, that was the real risk, was sort of how long would we expect oil prices to remain higher? And
Mhm.
the market's been looking through that, looking forward, trying to get past that point. And it seems like what stock markets are saying today is essentially the worst is behind us. And that's sort of the read at this moment.
No, thanks for that overview, Ankur. I think that's really helpful. So sticking on oil and gas prices, are we able to see yet how this is affecting consumers and inflation kind of in the longer term? I know this has, been a matter of weeks or months, but is this something that we expect long term to impact inflation and consumer behavior?
Yeah, it's interesting. I think with gas prices specifically, this tends to be the first thing that people look at. It obviously is not as large of a portion of spending as it used to be. I think gas prices here at $4 meant something very different, 30 years ago than what they do today. So it's not a great thing. I think it's more of a psychological sort of screen when people see gas prices sort of everywhere, right? They're printed, all over the place and you're sort of not avoiding them. It's sort of a constant reminder that prices are going up. So I think that does have an impact. I think when you look at consumer sentiment, it obviously has a big impact, right? Consumers are not happy right now. I think the one thing that I think you could mention alongside this sentiment picture is that even though consumers are saying they're not feeling great, all the earnings calls have been generally positive, and most retailers are still showing signs that the consumer is still spending. And so there hasn't been sort of a translation of this fear and sentiment into sort of actual spending yet. I think when you look at inflation, and so this is the gauge that we're concerned about here, we have seen an uptick. It has been driven by energy. I think you look at sort of where consumer prices are right now, CPI, you see 3.3% year over year. A big part of this sort of more recent jump from the twos to the threes has been all energy.
Mhm.
And that's been over the last month or so. So we can't discount that this could have an impact going forward, depending on how long this takes to resolve. Now, like I said before, equity markets seem to think this is going to be very short term, um, but that might not be the case. Equity markets aren't always right. And I think what we do know is that energy is typically one of the first things with inflation in terms of what might move, excluding sort of the pandemic, which was a different sort of situation. I think in a geopolitical risk like this, energy tends to be one of the first things that moves and then has a trickle down effect because all other sectors that are shown here are going to be impacted when energy goes higher. So it is the main question that I think markets have been struggling with over the last month is sort of how long are energy prices going to stay this high?
Mhm. No, I think that's really helpful context, Ankur. Thank you. Is there anything else as, investors and our clients think about what the war in Iran means for their portfolios? Is this how you've seen markets react to prior geopolitical events? Is this more extreme? How's it felt so far for you just watching markets?
That's a great question, Caitlin. I think, you know, to me, this feels like every time it feels like a little bit different. It feels like the market's peeking through, looking forward, not, sort of resetting as much as we expected because the drawdown was so quick and the bounce back was so quick. But I will say I have, looking back at the data, um, it tells a different story. This has been a more typical geopolitical event in market context. I think
Hmm.
markets always tend to find a way of recovering before the actual underlying issue recovers, as they are forward looking in that nature. And I think, looking at this chart, it shows us, how many times does the stock market, the S&P 500 here, come back down about 5% from recent highs. And you'll see last year we faced six of these moments alone. This is our first one of 2026. And you forget, right? Over time, like you're like 2026, markets were up, right? Even the 2 years prior to that, markets were up. But we do have these moments where markets have volatility. Um, you know, I took a look at what these events were. A lot of this was tariffs. Some of it was the government shutdown. Some of it was the AI fears and technology. Some of it was Doge. Remember Doge? That was
I
last year.
do.
That was one of these 5% pullbacks, right? And so it's interesting to take a look back and say, is this different in any way? It does feel like the market is not wanting to go down as much as in
Mhm.
past times, but the pattern shows this is more typical than not.
Great. No, I think that's helpful for us to look back and see those numbers.
Always, always.
All right. Anything else before we turn into our second topic for this today's call?
No, I think that covers mostly what's happening in public markets. Again, as Caitlin mentioned, if anyone has questions, we're happy to field them on the fly as we move throughout the rest of the conversation. So feel free to post.
Great. So I know the other topic, Ankur, that we're going to talk through is, in opposition to public markets, actually private markets. So something that's been in the headlines a lot recently is private credit. Specifically, funds like Blue Owl and others are drawing a lot of headline attention for selling some of their loans and capping investor withdrawals. So I'm going to give a brief overview of my understanding of private credit and then ask you some questions and see if you can fill in some of the blanks for me, if that works for you.
Yeah, let's do it.
Great. So private credit, it's usually so non-publicly traded, hence why it's called private, loans made by non-banks, so firms like Blackstone, Apollo, other private funds. And these have gotten really popular in the past couple of years, but have been gaining popularity since 2008. After the 2008 financial crisis, banks had a lot more lending requirements to give loans out to companies. And this is kind of where private credit began. And now there are trillions of dollars in these various private credit vehicles. The past decade or so has been primarily a very low interest rate environment. So private credit also gave investors a way to have slightly higher yield than they were seeing in, government bonds, other bonds. So what am I missing to set the stage for clients on what exactly is private credit and kind of what are the timeline of events leading us to the headlines that we're seeing today?
Yeah, I think one is just, that I think that was a good recap in terms of, the sort of growth happened all post 2008. I think one of the things to highlight is that the reason behind that, right, which is the financial crisis, you know, showed a lot of flaws in the current system. And that's
Mhm.
what we're talking about here. Private credit, like the big risk right now everyone's worried about is like, is there a systemic risk to the financial system within, and is that going to come to light because of the issues that are happening in private credit today? And I
Mhm.
think it helps to understand that context of, okay, if private credit was really born out of 2008, why? Well, banks were taking a lot of risks back then that, obviously didn't work out. And regulators had to come in and say, you're not allowed to take this much risk. You're not allowed to have this much leverage. You need to have a certain amount of liquidity and capital on your balance sheet. And all these rules were put in place. And what happened was banks couldn't make the same types of loans to these businesses anymore. People left those banks to start their own firms. And that's where a lot of this growth came from in private credit. So
Mhm.
that's the only thing I'd add is sort of that context. Because as we think through sort of what's happening right now, it's good to know like, hey, that's kind of what the starting point was. So if we want to answer that question of like, is this systemic risk? Is this something that's going to collapse the system? Like this was created to support the system is one of the first things I'd highlight. And then in terms of timeline of events, this has been interesting to watch unfold. I think last year was one of the first defaults that actually made headlines. And there were two defaults, I think both in the auto industry. And Jamie Dimon got picked up saying that, if you see one cockroach, there's probably more. Right. And
A
that's
good
kind
a
of
good quote to put in the headline.
yeah. And so that really to me like was one of the things last year that kind of kicked this off was sort of the fear of, are there more of these out there? Why are we talking about this now? After that, shortly after that, I think it was, the tech sell-off. Remember the chart that we showed with all the different 5% pullbacks? One of those was related to the fact that, everyone was in love with tech for a couple of years, and the AI hope could, do no wrong. And then all of a sudden, everyone was worried about what AI was going to do to the tech sector and software, and SaaS apocalypse started and all of that, right? And so you had this worry about private credit and more defaults. Then you had this concern about what is AI going to do to some of these companies. And then people started looking at companies like Blue Owl that, specialized in lending to tech software companies in this space within this middle market space that private credit tends to lend to. And so, that to me was sort of last year. And one of the moments that I think, and I think Blue Owl sort of started some of this chaos
Mhm.
by trying to merge one of their two of their funds together. And so essentially, a lot of these asset managers have private vehicles and publicly traded counterparts called BDCs. And so sometimes they have a non-traded private BDC and they have a publicly available BDC. A lot of the same loans are in both types of portfolios. They're just offered in different structures. Now,
Mhm.
what Blue Owl tried to do was say, hey, we have clients looking for liquidity. Why don't we just take the two funds and put them together? And then all the investors in the private fund said no. They basically said, we don't want this. The public equivalent trades on a stock exchange has that volatility that the private market investors were not looking for. At that time, the publicly traded equivalent was at 80 cents to the same dollar of NAV as the private vehicle. And so because of that, investors said no. Blue Owl had to sell close to $1 billion worth of their loan book to satisfy withdrawals, and then they had to close sort of the window for liquidity. Um,
Hmm.
and so that's sort of what happened last year, leading up to sort of more of the chaos and the, sort of continuation of redemption requests that we're seeing across the board, not just with Blue Owl now.
Yeah, no, that's helpful context. So, Ankur, maybe you can explain a little bit more. Why do funds have these caps on how much can be withdrawn? And if a fund is, putting that gate down of typically 5% withdrawals allowed each quarter, if that gate comes down, is that a problem with the fund? Is that a good thing, a bad thing, a neutral thing? Can you explain kind of the structure
Yeah.
of the funds?
Yeah, the structure definitely matters, and it's not a good or bad thing, I would say. It's a it's a feature, right? Like
Mhm.
this is built intentionally to support the structure of the underlying investment and how it works. And so the design is essentially you think about these loans as typically maturing within 5 to 7 years or 3 to 7 years. We'll call it 5 years. And the way the managers invest in these loans is they stagger them and they say, we're going to invest in a handful of loans year one, year two, year three, year four, year five. And so you can imagine if you have an average life of 5 years with a staggered maturities, you might have about 20% of your entire loan book maturing every year.
Mhm.
The the actual redemption limits are set to 5% per quarter, and that equals sort of that 20%. So that's kind of the design element of it, sort of saying, hey, naturally, you know, investors in this type of structure should get access to at least 5%, but no more than 5%. And that's also part of the feature element of this, which is to say that when there are times of stress, when there are redemptions that come in above the 5%,
Mhm.
fund managers are not mandated to sell in a distressed environment. They don't have to raise that because what ends up happening is if you have to sell more than 5% of your fund in an environment like today where a lot of funds are facing redemption requests, you would have to sell at distressed prices. That would impact the prices for everyone else in the fund, and no
Mhm.
one in the fund wants that. And so that's why I say this is by design. This is a feature of this type of structure. It's meant to protect the other investors in the fund.
That makes sense.
And
Um,
I think it also highlights the fact that like there's two different things I think people are concerned about right now.
mhm.
And the thing that started all this, one of the things that started all this was the risk of AI impacting software companies. And is that going to have an impact on the credit of these software companies and their ability to pay off these loans, which we don't know yet, right? That's just a hypothetical.
Fear. Yeah.
This could happen, right? And
Mhm.
that is a credit issue. That is not a liquidity issue, which is what we're talking about right now, which is how are these funds dealing with these redemptions? And so I think the point of just knowing that today it hasn't turned into a credit issue yet. This has been driven by liquidity in terms of investors re wanting to redeem ahead and having fears about the future, not necessarily fears about any sort of credit issues that are happening today.
Mhm. No, I think that's a helpful nuance. So, kind of going back to one of the questions you were teeing up as we started this conversation, is private credit big enough and a big enough, problem potentially that it could be a systematic risk to the broader financial system if
That
things
is
go
that
south?
that is the biggest question right now. Seriously, that is the thing that investors are concerned about the most, and for a number of reasons. I think you hear proponents of this industry, asset managers talk about this. Um, they frame it in a way where the size of the issue is relatively small. That
Hmm.
you mentioned this is like trillions of dollars. It's around $2 trillion in terms of size, but that represents, I have here, 3% of all US household and business debt and only about 10% of total corporate borrowing. So it's a small sliver of
Hmm.
outstanding debt, I think there are nuances in terms of understanding, okay, if AI is an issue and software is an issue, um, what if there are defaults? What if everyone's right? But what does that mean in terms of returns to investors? And I think that's where some nuances around sort of, when there are credit issues, what happens in these funds? What
Hmm.
is the difference between a default and sort of the recovery rate and how much the fund is still going to get back at the end of the day? It's not going to be zero, right? Which is kind of what the markets are pricing at this moment. When you look at the publicly traded counterparts, they sort of are mirroring the fact that a quarter to a third of these funds are in software, and
Hmm.
that software is worth relatively nothing right now. And so that's kind of what the discount is implying. And I think that might be a little too far to go with it. But at the same time, I think you can make a case that there have been people who've made the case that there is systemic risk because of just the market structure that's in place around these types of loans. Like we took one risk that was deemed not safe for the banks to do, and then we
Hmm.
moved it over here. And when we moved it over here, the guardrails that were put in place weren't perfect. The structures that like we defined some of the features that exist that help sort of limit the issues when you have redemptions like this, but they obviously haven't solved for everything yet. And I
Yep.
think what you have to think through is sort of the fact that these types of vehicles, when they raise a lot of capital quickly, like we saw post, like you mentioned, 2018, 2020,
Mhm.
they have to put that money to work. And all of these larger asset managers had to put it all to work at the same time. When you look across these portfolios and the companies and the loans that they're making, there's a lot of similarities. There's a lot of companies that are owned by a lot of these funds. So there is some systemic nature to this problem where if there are credit issues, it will not just impact Blue Owl. It will impact other private credit managers just due to the fact that this is not isolated issue in that respect.
Hmm.
There is exposure across the board that everyone owns. And I think the one, good thing right now is typically anytime you have um, these issues, I think understanding the economic backdrop is helpful, right? Like we are in a pro-cyclical environment. Earnings growth is positive. Interest rates have been coming down. Inflation has been coming down. It's been going up slightly more recently, but the hope is that continues going down. And so because we're in a good time, it's a little bit easier, I think, for the market to absorb some turbulence. And maybe,
Hmm.
maybe at the end of this, there is some learnings, some, benefit to going through this type of cycle for an asset class that is thought of as relatively new still, even though it's
Yep.
been since 2008. The growth has all been recent.
Hmm.
And I know from, just going to industry conferences over the years, hearing people talk about the growth in the industry, hearing people talk about, what are the risks that people aren't paying attention to now facing those risks, and then seeing hopefully we're in a solid economic backdrop, we can solve for some of it. And, funds could come out the other end, and there might be some better structures in place. Who knows what the solve is at this point, if there needs to be one, or if, I think the key is watching the sort of tide of redemptions and seeing how that goes over the next couple quarters. It doesn't seem to be going away anytime soon, but what type of forcing function does that have going forward is going to be interesting to watch.
Right. Yeah, I think the redemption requests are hard to unwind. I mean, we saw that with some of the privately or the interval REITs, B
Yep.
REIT and others a few years ago where they faced similar withdrawal queues that I think they might have recently been able to, stem the tide there, but it's definitely, a feature of a lot of these funds that I think, may have been mentioned maybe in the fine print and investors, you know, didn't think about it until it suddenly became reality.
Yeah, such a good point. Such a good point. We have had similar situations arise in the past. So we'll see where it goes from here. But that's a really good one. But Blackstone has not been immune. They have
Mhm.
been one of the funds that has been impacted. Their approach was actually very interesting. They when they were faced with withdrawals for their private credit, they run one of the biggest private credit funds, BCRED. They were faced with larger than that 5%. And their senior principals, executives, um, actually put up money to come up with the extra above and beyond the 5% to satisfy those redemptions. And so there is a debate right now on sort of, is this a good thing? Like, it is good to see that, firm employees are backing their own products and
Mm,
putting their money, like they have skin in the game. That's a good thing to see for investors. But I think the fact that Blue Owl, Blackstone has allowed for more than 5%, and then firms like BlackRock have said no, like 5% is a limit. It's there for a reason. We have to abide by it. There is a tension right now in terms of was that a good thing or not, and we'll see what happens going forward. But I'm interested to see if the redemption wave sort of slows down from here or it gets better. What we have seen is that discount I mentioned, that publicly
mm.
traded fund has been coming down since we started looking at it, it was closer to 30%. Now I just took a look this morning, it was under 20%. And so that gap is closing. So the market's starting to move in the favor. It's not out of the woods yet in terms of this issue, but there is some light, it looks like, at the end of the tunnel.
Yeah, hopefully, like most things, it's, somewhere in the middle of the past couple years have been, full exuberance for these types of structures. The past few months have been full despair for these types of
Yeah,
funds. And
exactly.
hopefully we're going to land somewhere in the middle of those two things.
Completely fair.
So something we've been hearing a lot from clients recently as all of this has bubbled up into the headlines is, is this a space that Ellevest has looked into? Is it something that we've considered for client portfolios?
Absolutely. So we love private markets investing here at Ellevest. Public markets are shrinking. There are more opportunities in private markets. They offer non-correlated returns to public markets. There's a lot of features that we love about private markets, but I think in this case, specifically to these non-traded or semi-liquid BDC funds and interval funds, those are structures that we've traditionally avoided. We just have not, as an investment team, been comfortable with the mismatch in the liquidity and the sort of the um, asset liability mismatch that happens when you have a structure like this, especially because we've invested through times of stress before. And so
Mhm.
we've seen even if you explain and educate investors on, here's how funds work, here's what's happening. When there are issues, there's typically a stampede out the door. Everyone wants their money back all at once, and it usually doesn't work out well. And so for us, this type of structure typically has not been something that we favored. I don't think it's something that we never do. I think it has to make sense in terms of what you're investing in. You always have to know sort of what you're investing in, why you're investing in it. Does it match does the structure match the investment? To us, that's really important. And, you know, I think sometimes what you don't invest in is just as important as what you do invest in. So at this point, I'm glad we haven't.
No, I think that's a very good point, Ankur. Great. Well, I don't see any questions that have come through the queue. And I think that summarizes everything that was on my mind as it relates to private credit for right now. So I think we'll go ahead and end there. And thank you for all your thoughts, Ankur. It was illuminating as always to hear your
Absolutely.
perspectives.
Thank you, Caitlin. Thank you, everyone else, for joining, and feel free to submit any questions or reach out if you have any thoughts.
Thanks, everyone. Appreciate the time.
Take care.
Bye.